One of the most common ways for leverage to be used is when we buy a house. When we buy a house, it tends to be a very major investment. We tend to need a mortgage to make the investment. So we end up borrowing a part of the money. So let's say the house is, for making a number easy, $100,000. Which is obviously quite unrealistic given house prices, but just to make the argument easy, if we buy a house for $100,000, we borrow $50,000, then we have $50,000 of equity, and our returns will vary again according to the principles of leverage. In the case of a house, however, what's interesting is that we tend not to have to sell it, especially the one that we're going to live in. We tend not to have to sell it for a long period of time, so the short-term negative price fluctuations won't impact us as much, and also it tends to be a more stable asset anyway, so that it doesn't really potentially drop as much that quickly. So the likelihood of us losing that much because of the leverage is probably somewhat reduced. Plus, it's a hard asset that can be sold, and therefore there's less inherent risk. If we were to use leverage to buy, for example, if we were to borrow money to buy a piece of clothing, then arguably that piece of clothing, as soon as we bought it, would have dropped quite a bit in value, and therefore using leverage would have probably not made a lot of sense. When we borrow money to buy things that have a high likelihood of declining in price, for example, if we're borrowing money to buy food or clothes, that often can lead to problems, because basically what we're buying is going to be consumed or is going to decline in value significantly, but the debt that we use to buy it is going to continue to grow. And especially if we use, for example, credit card debt, which might have an interest rate of 20%, this debt will increase by 20% roughly every year, which means in effect that it probably doubles within a 5-year period if nothing is paid back, either interest or principal, whereas the item that we bought has effectively declined to zero. So using debt, or even leverage as it would also be referred to buy things that have a high likelihood of declining in value really doesn't make a lot of sense. Does it make sense to borrow money to buy stocks? Well, stocks also tend to be quite volatile, and for a lot of us, the short-term price movements of stocks, buying stocks on margin and things like that, can be quite disadvantageous, and probably for most of us it really wouldn't make any sense to borrow money to buy stocks. That's where a house purchase is quite a big contrast. That's why when we borrow money to buy a house, interest rates tend to be lower, because the person lending the money knows that that house can be sold for a value that's probably close to what we paid for a price that's probably close to what we paid for it. They know that the prices don't fluctuate that much, and they know also that when you live in a house, the likelihood of you having to sell it, or needing to sell it, or wanting to sell it, is slightly reduced, whereas when you're trading around in other things, including stocks or buying things that have a high likelihood of declining value, the situation is very different, and therefore the interest rates also tend to be higher.